Stocks. A stock is fractional ownership of a company. The stock may provide payments, also known as dividends. The amounts of such payments and the schedule for when they are paid, while not guaranteed, is usually quite predictable. Should you wish to sell your stock, the market will set the price. Contrast this with a bond, a financial instrument that offers periodic payments. In exchange for money up front, the bond issuer promises to pay the bond holder certain fixed amounts on a fixed schedule. At the end of the bond's term, the holder receives the face value, also called par value, of the bond, again a fixed amount. Typically, stocks are bought and sold on exchanges where anyone can participate. A business whose stock is listed on such an exchange is a publicly held or publicly traded company. Let's explore this further. Companies often need to raise capital for a variety of purposes, including expansion, paying down debt, rewarding initial investors, purchasing equipment, hiring workers, marketing, advertising, and so on. One place to go for money is the public markets through the issuance of shares of stock. Each share of stock represents fractional ownership of the company. The more shares issued, the smaller the fraction of the company owned per share. A stock's price reflects the expected value of the company. How one arrives at the value varies and includes considerable assumptions, opinions, and predictions for the prospects of the company and its competitive position over time. If you think a company is worth more than the person offering his shares does, you buy the shares from him. If you think a company is worth less than someone else does, you sell your shares to him. Usually, many shares change hands many times per trading day. Also note that market participants vary in how long they intend to hold on to shares, perhaps moments, days, months, or even decades. For a company, issuing stock might bring with it an obligation, admittedly with some wiggle room, to pay dividends. Further, a stock also may come with voting rights, a say in how the organization is run. A business needs to weigh the pros and cons of issuing stocks, bonds, borrowing from banks, etc., when considering whether, when, and how to raise capital. A company's stock is one way to evaluate a potential or current employer. Generally, public-held companies, those whose stock is traded on a major exchange, have more financial resources than privately held ones. Note that some private companies are quite well funded, though most are small. More money to pay salaries and benefits, support local and international facilities, invest in research, and so on can mean more income and professional opportunities for you. When you look at the price history of a stock, a slow and steady trend upward is a sign of stability and solid long-term prospects. Significant movements up and down, also called volatility, can signal that investors keep changing their minds about the company's future, likely because it depends on a few major offerings, such as technical innovations or blockbuster drugs, or macroeconomic conditions, such as the price of oil, chances of a recession, and the like. Working at such a company can be interesting or too interesting. A rapidly rising stock can indicate a rapidly expanding company. If you are already working at the company, good times may lie ahead. If you are considering the company, it may be worthwhile getting on board. Note that some very young companies grow quickly based on potential rather than reality. If the rosy predictions fall short, the company and its stock can collapse rapidly. A steadily declining stock price is not a good sign. Some private companies plan to go public through an IPO, initial public offering. An IPO can mean significant rewards for people who already have an ownership stake in the company, such as founders and investors. If you are at a company that plans to IPO and you already have a stake, staying with the company may be a wise decision. Of course, plans do not always come to fruition. If you are an employee with no significant stake, an IPO is not a payday intended for you. You should know if your company is publicly traded and, if so, should be aware of its stock price and its changes over time. Publicly traded companies publish an annual report containing lots of useful information. You should read any reports for your company and its competitors.